Welcome to another Southbank weekly bulletin. So here's a chart that I created about 11 years ago, and it took the balance sheet totals for all the major central banks, added them together, and redenominated each into US dollars. So then we would have a global measure of the size of central bank balance sheets, because as early as 2012, it was quite obvious that there was a strong correlation between the performance of the stock market and the size of central bank balance sheets. And rather than simply looking at one, I wanted to look at all of them because the way that I think about the world, the foundation of that is based upon a single premise, which is that capital is global and mobile. It will flow to the most attractive assets. So when there's more money around, it's easier to make money. When there's less money around, it's harder. And as long as we are aware of that, then we can frame an investment strategy to benefit from both scenarios. So we can see very clearly that this trend was rising in 2007, accelerated in 2008, then pulled back. But then it kept going again. And then between 2018 and late 2019, it went down. And then, of course, because we had the pandemic and untold monetary and fiscal accommodation, then the size of the total assets on central bank balance sheets went from about 20 trillion to well in excess of 33 trillion. So that was a jump of more than 50%. And now it's starting to come back down. So we had a good sized rebound from October through to the end of January. And now we've seen it starting to come back down again. And at the same time, we saw stock markets globally rebound from October through to about January. So here we can see it quite easily. The the S&P 500 bottomed in October, rallied through to the end of January, and since then it has been pulling back. So now we can see clearly there's a correlation. We can also see that if stocks are going to rebound from here, the chances are that it's going to be associated with a move higher in the total assets of central banks. So then let's just look at the UK. So here is the Bank of England's balance sheet, and it got almost up to $1 trillion at the end of 2021, and since then it has come back by about 100 billion. And that's a lot of money getting taken off the size of the Bank of England's balance sheet. It means that they're selling bonds, or at least that they're refusing to buy more, and they're allowing those that they do own to expire. Well, that is putting upward pressure on bond yields. So the 10-year gilt is up now to about 3.86%. Now, let's remember that back in September and October, we had the pensions crisis, and the Bank of England had to act with a great deal of alacrity and get busy with buying bonds. And then they actively brought the 10-year yield down by about 150 basis points in the space of less than 2 months. So that was a lot of buying. But even during that time, the size of the Bank of England's balance sheet has been contracting. And now those yields are starting to push back up again. Now, the one thing that I think is especially interesting is on other occasions, when we've seen the ECB or the Federal Reserve reduce the size of their balance sheet, the first thing that happens is that those bond yields go up. And then because it creates fears of deflation, and it creates a fear that I guess, let me rephrase that. When they begin reducing the size of the balance sheet, it creates a fear that the Bank of England will no longer, or the central bank will no longer buy the bonds. So that removes demand and the yield goes up. But Then, because money is being withdrawn from the market, fears of deflation and recessions take over. And that makes bonds more attractive. And because the yield has gone up, then investors start to get interested. And a yield of 4% is certainly a lot better than zero. And a lot of treasury management strategies start working again when you've got a yield of 4%. I've met more than a few bankers who are very happy with the interest rate environment right now because they can start offering and competing on deposit rates again. They haven't been able to do that for more than a decade already. So that is going to start creating demand. Now, of course, we have these big questions about inflation, and that's not something that's about to evaporate overnight. But it's not really about the uh, it's not really about the absolute level, but more really about the year-over-year change. So if we look at that year-over-year change, we're up now at around 10%. So that's obviously problematic. But 10% is better than 11%. And we're not going to have another reading from the statistics office until the 22nd of March. But what happens, for example, if the year-over-year change comes down to 9%? There's going to be a lot more enthusiasm around the potential that inflation is starting to roll over. And we can then marry that up with what's happening in the stock market. Because the FTSE 100 is right in the region of its all-time peak and still very steady. So what the stock market is pricing in is that inflationary pressures are probably peaking, and that instead what we should be thinking about is that inflation isn't going to be quite as much of a problem. The upward pressure on yields isn't something that's going to be permanent, and that companies will thrive as a result. So it's important to also bear in mind that the FTSE 100 is a very global index. It's filled with large companies with global franchises. So when it does well, it's not only pricing in the potential for the UK, but more importantly, the wider global environment. Of course, it is also very much reacting to what's happening in terms of the pound. And the pound is hovering here around the 120 area. Now we can see that there have been several occasions over the last 6 or 7 years where 120 has been support. But then it did drop down through it in 2022. So we're at a critical juncture here. But certainly a somewhat weaker pound over the course of the last month has helped to support the FTSE 100. Now then let's pay attention to the FTSE 250. So this is much more representative of the domestic UK economy in terms of the earnings from those companies. But then these are smaller companies too, so they do tend to be more volatile. But importantly here, we have seen a good-sized rebound off the lows in October, and now we have the first evidence of support starting to come back in the region of the 200-day moving average. I think it is quite clear here that the downtrend has been broken. So that is now holding out the potential that a new uptrend is forming. So there's certainly reason to be a bit more enthusiastic. So with higher yields and the prospect that inflationary pressures may be close to peaking, then the banking sector has also popped on the upside here. Now, it's a bit overbought. And if we just zoom in and look at just a year of data, well, we can see just how quickly it ran up. And now we're getting a little bit of pause and consolidation, because that was a big move up from 2,800 to almost 4,000. So I think we're going to have to see evidence then of the UK economy beginning to stabilize more. But certainly there is hope now that some of the worst is behind the economy. Of course, the big wild card here is going to be oil. And prices have been very steady around the $80 area. The one thing that I think is most especially important to highlight is if we look at a decade of history and just simply look at these periods where oil has been locked in around a $10 range, that every single time that happens, we get an explosive move afterwards. And at the moment, at least, there's the potential that oil prices will rise from here. If global economic growth picks up, and the FTSE 100's performance is suggesting that it will, and of course we have China's reopening coming in with stronger figures overall, then that's also boosting the prospects for global economic growth. And because large oil companies haven't been investing a lot of money in new supply, then there will be a supply inelasticity environment. Now, the reason I put up this contract schedule is that we now have a backwardation in oil contracts. But what that means is that each of the contracts is higher than the next one. And what that's referred to in the commodity markets as backwardation. It means that investors would rather buy at a higher price now than wait for a lower price later. And that is reflective of a sense of urgency. So that is bullish for the price. And obviously, if oil prices surge from here, well, then that is something that would contribute to inflationary pressures down the road. So even though I think we're close to a peak, if not that inflation has already peaked, there's the potential here that there are wild cards out there that could upset the apple cart, and oil is certainly one of those. And I think with that, I'll leave you for this week and wish all the best to all of you.